All right. Well, welcome everybody. Thank you for joining us to our brand new presentation of your roadmap to home shopping and loan closing. Thank you again, Nevin, for hosting us and allowing us, giving us the opportunity to present this to you. So I'm going to skip this one because this talks about handouts that we typically email out, but these you can download from the Santa Clara Library event directly. But I would like to tell you a little bit about who we are. Sorry, apologies. So Habitat East Bay Silicon Valley is a nonprofit, and we serve people in Alameda, Contra Costa, and Santa Clara counties. Now, our organization is a HUD-approved housing counseling agency. And what that means is that we offer a range of services that help people achieve financial fitness. We offer one-on-one counseling, financial education workshops like the one today, online financial education, and first-time homebuyer classes. Now, with one-on-one counseling, we offer free individualized guidance by a HUD-certified housing counselor, and is available to anybody who would like to learn how to manage their personal finances, which includes learning how to budget, save, manage debt. We also offer credit counseling that teaches how to build or rebuild a positive credit history, and home pre-purchase counseling. And that's for those people who would like to understand how the home buying process works and what they can do to become financially ready to purchase a home. We offer monthly webinars through our website on a number of topics. So if you visit us at habitateBSV.org and click on our events page, you can see all the webinars that are coming up. Right now we have March and April. So please check it out. They're free. And we also offer homeownership opportunities, affordable homeownership opportunities, and home repair services. So, and on our website, you can learn about all of our services. But today we're going to be covering the home purchase process. We'll talk about shopping for a home. We'll review the closing process, and then we'll also touch on what to do after you get the keys. All right, so the home purchase process. Well, purchasing a home, as you all I'm sure know, is a really big investment, and it's probably the most important investment you'll make. So it's crucial that you understand the various steps that are involved in this process. So the first thing you should do is determine if buying a home is right for you. Are you ready? So is it right for you? Is it right for you right now? Think about your goals in the next few years. For example, is there a chance you might need to relocate for work? Are you thinking of starting a family? These big picture questions can help you determine if this is the right time to buy a house. Also, evaluate the financial trade-offs of renting versus buying. For example, when you own a home, you have housing expenses that you don't have as a renter. It's harder to move. When you rent, generally the longest time you commit to live in the home is 1 year and often is month to month. So all you have to do is give a 30 days notice. But when you own a home, if you have to move, you would have to sell it before you're no longer obligated to pay the costs that are associated with it. You also want to consider the risks and responsibility of home ownership. You can't call your landlord when something breaks, so you'll be responsible not just for scheduling the repairs, but also covering the costs. Your home value could decline. You could lose equity and even end up owning more than your home is worth. So are you ready to take this risk? Now, owning a home is expensive. In addition to your mortgage payment, you'll have expenses like property taxes, homeowner insurance. You will also have to make a down payment, which can be anywhere from 3 to 20% of the purchase price, and also pay loan closing costs, which range between 2 to 5% of the loan amount. So it's very important that you assess your financial situation. Make sure your finances are solid and you can comfortably sustain an increase in housing costs. Go a step further and calculate how much you can afford to add. Understanding your financial limits will help you avoid buying a home that's beyond your means. So here are some things to consider. Are your income and expenses balanced? Are you able to contribute to savings each month? If you're struggling to keep up with expenses and unable to save, then you need to carefully consider whether you should take on the financial responsibility of homeownership. Do you have enough in savings to cover the down payment and the closing costs? And will you have a healthy savings cushion left after paying them? How much debt do you owe currently? If you're having trouble keeping up with your debt payment right now, for example, maybe you have credit card balances you're trying to pay off, so you have loans, then you need to think carefully whether you should add more debt. It's important that when you speak to a lender, you do so as an informed consumer. So take the time to research types of home loan programs, learn how they work. For example, conventional loans, there's conventional loans. These are not guaranteed by the federal government. They can be more flexible than a government insured loan, but also harder to qualify for. There's government insured loans. These are backed by one of three federal government agencies, which are the Federal Housing Administration, the U.S. Department of Agriculture, and the Department of Veterans Affairs. And generally, these have easier qualification requirements than conventional loans, but the home buyer must meet the program's guideline requirements and also work with an approved lender. And there are assistance programs you can look into that help home buyers cover down payment and closing costs. These are loans which must be repaid on top of your mortgage loan. When and how much really depends on the program. Now, before you start shopping, get pre-approved for a mortgage loan. With a pre-approval, the lender makes a conditional commitment to grant you a loan based on certain assumption. For example, that the home appraisal value meets the agreed upon purchase price. Now, pre-approval will give you a home price range you could afford. So you and your real estate agent can target your home search to your price level. It will also make you a more desirable buyer because it shows that you have a lender who would be willing to lend to you under certain conditions. It's also sometimes required to apply for certain home buyer assistance programs, and some sellers may require it before accepting an offer. Of course, having an expert on your site can make all the difference. So you want to find a real estate agent. A good one will guide you through the home buying process. Before you begin your home search, create a checklist of your essential requirements and desired features. And then once you find a home that you want to purchase, then you submit an offer letter in writing. If the seller accepts the offer, you sign a purchase contract and make an earnest money deposit, which shows the seller you're serious about buying that home. The amount typically is 1% to 2% of the purchase price. And now it's time to choose a lender you want to work with and submit a loan application. Soon after you sign the purchase contract, you need to schedule a home inspection so you can determine the structural and mechanical condition of the home and make an informed decision on whether you should buy it. You also should start shopping for homeowner insurance because at closing, the lender will require proof that you're covered. So it's important that you start this process early on. And then once you receive a final loan approval from your lender to close, you want to make sure that you do a thorough review of all documents. Even if you're 100% committed to the property, make sure you do a final walkthrough of the new home to check and make sure everything is as it should be. And then the final step is signing closing documents. Be prepared to bring at the meeting an acceptable form of payment to cover the down payment and closing costs. And we'll go into more details about all this. Now, here are some of the professionals that you'll work with as you go through the home buying process. Real estate agent, brokers, and realtors are trained licensed professionals who help with negotiations, research homes in the area, and sort through active listings and assist at closing. The home inspector is hired by the buyer, makes a detailed physical inspection of a home you want to buy, and then provides you with a report on the condition of the house. And the loan officer, who's also known as the loan originator, helps you complete the loan application and review financing options that meet your financial capability. The home appraiser is hired by the lender to determine the current market value of the home you want to buy. And when you buy a home, the lender wants to protect itself from risks to the home, as well as possible claims against ownership of the property. So they'll require not just homeowner insurance, but also title insurance. And so different insurance agents may be involved in this process. A buyer's agent helps the buyer shop for listed homes, make competitive offers, and negotiate with sellers. Usually the seller pays the real estate commission, which the listing agent splits with the buyer's agent. A real estate broker has received additional training beyond what real estate agents receive to get a broker to get a broker license. Now, a broker can oversee other real estate agents, work under a managing broker, or operate independently. When shopping for a home, you're more likely to work with an agent, as most brokers spend their days overseeing the real estate brokerage and supervising individual agents. And here are some ways you can connect with real estate professional. Word of mouth, referrals is probably the most common way. You can ask people you trust, for example, friends, family, or colleagues, neighbors who recently bought or sold a home. You could ask them, have they worked with realtors? Do they recommend them? And then you can also use your social media connections. You can do an online search, look up agents' websites, online profiles, social media accounts they use to advertise listings, and check customer reviews. You can scour your neighborhood or the neighborhood where you would like to live for homes for sale and see which realtors and companies are listing homes, and then attend open houses so you can meet them in person. You can check official referral resources like the local Chamber of Commerce where you plan to buy the home, and you can also search for agents on realtors.com. Now, once you have a list of agents who seem like a good fit, check their credentials. Look on the California Department of Real Estate website to verify that the agent is licensed or if there have been complaints filed. Check also that they belong to the National Association of Realtors. That means that they've taken a pledge to abide by the association standards and code of ethics. Then set up interviews with at least 3 agents who specialize in the area or neighborhood you want to buy your house. An agent who has local knowledge can best advise on sales price trends and help you narrow down the neighborhood based on your financial and personal priorities. Now, at the interview, ask about their experience. For example, how many homes have they sold in a specific location in the last 6 months? How long have they been in the business? Ask also if they will only represent your interest through the entire process, because in some cases, an agent can represent both the buyer and the seller. And this is also called dual agency. Now, sellers and buyers must consent to dual agency. So it's important that you request a written form that discloses the relationship before you sign. And check how they communicate. How promptly do they reply? Will they accommodate your preferred communication method? Do they understand your budget and needs? If you will also be working with an assistant, make sure that you will have enough direct access to the agent. Before you start looking at home, consider all the options and weigh their pros and cons, both financial and in terms of features the home must have to fit your list of needs, must-haves, and would like to haves. Now, single-family homes offer greater privacy, typically have more space, and usually you have more freedom to make changes to both the interior and the exterior. The disadvantages are that you're fully responsible for maintenance. They also tend to be more expensive. And the higher purchase price means that the monthly payment will be higher. You'll be required to put down a larger down payment. Closing costs will be higher. Property taxes will be higher. And the larger square footage also means higher utility bills and maintenance costs. Townhomes typically are more affordable than single-family homes and are usually part of an HOA community, which may include amenities like children play areas, fitness centers, pools, community gardens. Now, the disadvantages are that they may have less living space in a single-family home and less privacy because they share walls. You would also have to follow HOA rules and pay HOA dues. Now, HOA stands for Homeowner Association. It's an organization that sets and enforces rules and standards for a housing complex. In addition to offering amenities, it takes care of maintaining common areas, which means you don't have to schedule the work, You may also organize social events, which can make it easier to get to know your neighbors. But these amenities and services come at a cost. So you'll have to make monthly payments, which can be hundreds of dollars. So it's important to carefully consider whether you can afford them. You'll also have to follow HOA rules, which may limit your freedom to change the exterior and interior of your home. Condos are less expensive than single family homes and townhomes, and they too are part of an HOA community. The disadvantages are that they typically have less living space than townhomes. You'll also have less privacy because you will share not only walls, but you will also have neighbors above and below you. Now, if you really want a detached single family house, manufactured homes are a less expensive option. They are built in a factory and then transported to a site. They're sold through retailers, or you can buy them from someone who owns a home in a manufactured home development. So here are some advantages. Usually they cost less per square foot, so you can get more space for your money. They must meet energy efficiency and safety standards. If you're buying a new home, you can customize the floor plan and the exterior. And if the home is in a mobile home park, it may offer community amenities. And some of the disadvantages are that if you buy a new factory built home, you'll need to find a place to put it, either on a leased lot in a manufactured home community or land that you rent or buy. If the home is in a mobile home park, you'll have to pay space rent, which can be hundreds of dollars per month. And manufactured homes that are not fixed to permanent foundations are titled as personal property. So they're not eligible for most traditional mortgages. Loans that are used to finance personal property homes have a higher interest rates than traditional mortgages. When you look for a home, it's about choices and priorities. Before you start shopping, it's important that you decide what the house must have and what you can do without. So to help you create a checklist of all the home features you are considering, for example, proximity to school, work, public transportation, shopping parks, the type of neighborhood that you want. For example, do you want the home to be in a safe, walkable, quiet neighborhood? Is a well-performing school district important? Do you want a new home or is a fixer-upper okay? How many bedrooms and bathrooms do you need? Do you want extra features like a yard or a pool? What type of home are you considering? A single family, townhome, a condo, manufactured house? And then prioritize your list and determine which features or needs, which are wants and which are deal breakers, and then put them in order of importance. Now, needs are things the home must have. For example, enough bedrooms to fit your family size. Wants are things that you would like to have but can live without. For example, you must have enough bedrooms to fit your household size, but you don't need the extra bedroom for guests. Deal breakers are non-negotiable. For example, maybe safety is a must for you, so the neighborhood crime rate is important. Or maybe a short commute to work or proximity to family is very important, so location is on top of your list. Think also which home features you do not want. For example, being on a busy street. As you prioritize, weigh the pros and cons, including the additional costs they might bring. For example, if you want a yard or a pool, you'll have additional expenses to maintain them. Can your budget sustain that additional cost? If you want air conditioning, you need to include costs to run it. Air conditioners also require maintenance, which can be costly. If you're considering a fixer-upper, consider whether you'll have sufficient funds remaining after you have to cover all those high on buying upfront costs to afford the expenses that are associated with the repairs. Also keep in mind your future needs 5-10 years from now. For example, maybe the school district is not important right now, but if you're planning to start a family in the future, it may be something you should consider. Now, going through this exercise will help you stay focused on what really matters to you, stay on budget, and avoid buying a home that you end up struggling to keep up with financially that impacts your lifestyle and limits your ability to reach other financial goals. So let's review some best practices to follow when shopping for a home. Bring with you a checklist with the home features you decided are the must-haves, nice-to-haves, and deal breakers. It is a good idea to have separate checklists for each room and one for the home as a whole. As you look at homes, take pictures to help you keep the information clear and organized and remember details about each home. Compare the market value of the home you're considering. Look at the final price of homes sold within the last 90 days that have comparable features, like same number of bedrooms, bathrooms, location, square footage, and extra features like a swimming pool. Once you find the right home, learn about its sale history. For example, how long has the property been on the market? The longer it has, the more been on the market, the more willing the seller may be to negotiate on the price. How anxious is the owner to sell? Maybe they're moving and need to sell the home. Is it truly a quote unquote new listing, or was it on the market recently and then taken off? If it was the price reduced? Are there any offers pending? Now, realtors and sellers must disclose if there's anything wrong with the property. So ask about the condition of the home. Look for things that could adversely affect the value. For example, has there ever been flooding, or have there been major leaks? And if yes, was it fixed? And can they provide proof? And was it fixed properly? Is the property on a fault line or a landslide zone? Were repairs or improvements done to code? Did they get the proper permits? For example, if they redid bathrooms or the kitchen. If the home is in an HOA, ask to see the bylaws. These are the HOA rules. Make sure that you're comfortable with them, and make sure that you also check what the monthly costs are, how well the HOA is maintaining the common areas, if the association is managing the money properly and has a reserve. If the HOA is in financial trouble, it may be a red flag that the dues may be in line for an increase. And if there are special assessments coming up, these are costs that homeowners must help cover in addition to the regular monthly dues. When a buyer is ready to make an offer on a home, real estate agent will write the offer. If the seller accepts it, the buyer and the seller sign a purchase agreement, which is the legally binding contract, and it generally includes the legal description of the property, the price you're offering, items that the purchase includes, for example, ceiling fans, chandeliers, refrigerator, washer, dryer, how long the offer is valid. The deadline when the offer expires can be just hours in hot markets, but in most cases is 1 or 2 days. A good faith deposit amount, it's also known as earnest money. This is a deposit the buyer pays to show the seller they're serious. If the contract is terminated for permissible reasons, the money is refunded to the buyer. Otherwise, it may be forfeited and paid out to the seller. Details regarding closing costs and other fees, including which party will pay. Seller disclosures. This includes details about the information sellers must provide and when they must deliver the disclosure to you. The proposed closing date, which is typically 30 to 60 days, though it can vary depending on the lender's underwriting process. The proposed occupancy date, which is the deadline for the seller to vacate the property and hand over the keys. And the right for the buyer to do a walkthrough inspection of the home before closing to make sure everything aligns with the agreement and the seller disclosure. And finally, contingencies. Now, real estate contingencies are contractual conditions that must be met for a home sale to go through. They protect the buyer from losing the good faith deposit if they back out of the deal because certain conditions aren't met. Without a contingency in place, the buyer risks losing their earnest money deposit, and if they decide not to purchase the home after making the offer. Now, contingencies can also be used as leverage. So here's some example of some common contingencies. The home inspection shows no evidence of problems, for example, to the home structure, lead, roof, pests. That the buyer can secure financing for the property. Even if you have a pre-approval letter, this is important to include because you're not guaranteed that you'll be approved for a loan. That the title of the home is clear and there's no issues over ownership, meaning no liens or judgments. That the property does not appraise less than the purchase price. Now, throughout this process, you'll want your agent to guide you. And in some more complicated cases, you may even want the advice of an attorney. All right, we have a quick knowledge check. Nevin, are we able to use the chat? I think so, right?
Yes.
Oh yeah.
Let me double check.
Okay.
You should be, yes.
Trying to.
Okay, I enabled it. Yes.
Oh, okay. Great. All right. So, question one. What are some things that you should do to make sure that you're ready to buy a home? So we taught this at the very beginning, and it's okay if you don't know the answer. The point of this knowledge check is just to kind of take a breather, make sure that what we talked about is clear, and maybe talk about it a little bit more just to make sure that it is clear. And I don't believe, Nevin, I can see the chat. If people are, I don't know why. If people are chiming in,
I see the chat, and
is anybody?
dear attendees, if can you test it? Say something yes, no, then we can see it. Probably it works. Maybe they don't know the answer. Oh, one is assessing financial situation.
Perfect. Yes.
Thanks,
Thank you.
Kelly.
Yeah, for some reason I don't see the chat feature on my bar. I don't know why.
Okay. I can read them for you.
Thank you. So absolutely, assess your financial capabilities. Another important thing to do is to think about future goals. And it's also important to evaluate the financial trade-offs of renting versus buying. I always think of it this way: when you're renting, the maximum you'll pay is your rent amount. When you are buying a home, the minimum you'll pay is your mortgage payment. So it's important to keep this in mind, that all the financial trade-offs. And of course, carefully consider the risks, the responsibilities. So it's great, owning a home is awesome, and it's a great goal to have. But it's very important to go into it with eyes wide open.
And there's another thing, doing home inspection.
Yes, for sure. So that's once you identify the home you want to buy. But this work that you need to do is important that you do before you even start shopping for a home. Because once you get in the process, and you find that home you just fall in love with, is really hard to stay more rational and think about these things. So it's important to do this work before you even start looking at homes. Okay, one more question. Contingencies. How can it help to put contingencies in a purchase contract? Why are they important to include? I'm going to check here again if I can see. I don't know why I cannot see chat. That's so weird.
I don't see any answer. Maybe we are thinking.
Are we thinking, or okay.
Maybe one example you can give us?
Yeah. So I'll give you an example of a home contingency. Clear title, home inspection. So these are just a couple of examples. So they're important to include in a purchase contract, to write them in, because it gives you the opportunity to back out of the deal and get your deposit back. For example, let's say you do a home inspection. You put a home inspection contingency. You do the home inspection, and they find that there's some serious problem with foundations, or some problem that that really shows you that you just don't want to deal with this home. It allows you to back out of the contract without losing your deposit. So very important to include them. All right, so let's move on. Now, once the purchase agreement is signed, the buyer needs to submit a loan application with the lender of their choice. When you apply for a mortgage loan, you want to make sure you shop around, talk with more than one lender, and then you compare offers so you can pick the one that's best for you. You could start talking with your bank or credit union, and you can also ask for recommendations from people you trust. You'll start by discussing the type of mortgage you're interested in with the lender, and then you complete and submit your loan application and provide personal and financial documentation. No later, the underwriter, once you submit your application, the underwriter will then review your loan application and documentation. And then no later than 3 business days after they receive your loan, the lender receives your loan application, they must provide you with what's called a loan estimate. So you want to make sure you carefully review this form with the lender. Now, the loan estimate is not a commitment to lend, but it shows you what loan terms the lender expects to offer if you decide to move forward with that loan. Loan estimates are not binding, and you can get them from multiple lenders. To help you choose the best loan for you, then you can use the loan estimates to compare loan offers. And here's some things you can look for. Is the interest rate locked? If yes, when does it expire? What is the monthly principal and interest payment amount? How much are the closing costs? Now, closing costs are expenses home buyers pay when they close on the purchase of a home, and include things like application, attorney, underwriting, processing, and administrative fees. You also want to compare the annual percentage rate. The APR reflects the interest rate plus the fees that you pay that lender to get the loan. Now, lenders may quote the same interest rate, but charge different fees. And so comparing one loan's APR against another loan's APR will give you a fair comparison of how much each loan will cost you overall. Now, once you've made your decision which loan offer to accept, you let the lender of your choice know you accept it. And then now your loan application will go through more review, additional documentation, information may also be required. So it's very important that you're always ready to submit what the lender needs and answer questions, because missing or late paperwork can cause delays. And if new or different information is discovered, then you may receive a revised loan estimate. And after all the reviews complete, your loan will be either approved or denied. The home inspection is not required, but it is highly advisable. Again, it can identify potential issues and give you a better idea of the ongoing maintenance the property will require. So you can make a more informed decision about the home you're considering buying. Now, the buyer does pay for this cost, which is around $300 to $500, but the investment is well worth it. So the home inspector will do a visual assessment and report on the house's physical structure, mechanical systems, including the roof, foundation, drainage, plumbing, heating systems, central air conditioning systems, visible insulation, walls, windows, doors. If the home inspection finds problems, then you can ask the seller to make repairs or request a credit in an amount that's enough to cover the cost. And if you decide it's not the home for you, provided you included the inspection contingency in your purchase contract, then you have the option to back out without losing your deposit. Now, do keep in mind the contingency period has an expiration date. So it's critical that the inspection is completed and that you have received the report before that date expires, or that date, you reach that date. Now, you don't need to be present during the home inspection, but this too is highly advisable. You can pick up valuable maintenance tips, ask questions, find out about future repairs that may not be critical now. Now, as part of your loan application review, the lender will appraise the property to make sure the value of the home you're buying is not lower than the purchase price. The home appraisal is required in order by the lender, and the home buyer pays for this as part of the closing costs. The appraisal provides an estimate of the value of the property, taking into consideration things like local market trends, the home lot size, square footage, home amenities, age and condition of the home, sales prices of comparable homes in the same neighborhood. The buyer is entitled to a copy of the appraisal prior to closing. If the appraised value of the home is less than the purchase price, then you may be able to use that information to negotiate a lower price with the seller. And of course, if you include it in your contingencies that the home must not appraise lower than the purchase price, if the seller is not willing to lower the price, then you'll be able to back out of the deal and not lose your deposit. Now, the closing process is handled by an escrow or title company, which is a neutral third party that holds the money and legal papers before closing on a property. And this is where you go to sign your legal documents, pay closing costs, and take title to your new home. In addition to the buyer and the seller, at closing, the following people will be present. The closing agent, who's responsible for the legal transfer of title and ownership from seller to buyer. The title officer, their job is to research public records related to the ownership history of a property. Both the buyer and seller real estate agents may be present. And the loan closer, and their job is to record the closing documents and disperse the money to the appropriate people. 3 business days prior to closing, the home buyer gets the closing disclosure. This is a 5-page form that provides final details about the mortgage loan the buyer has selected, and it includes the loan terms, the projected monthly payments, closing costs. You want to make sure you review the closing disclosure and compare it to your most recent loan estimate, and check if the loan type, interest rate, monthly payment, other key terms are the same. There are fees that you don't understand or have changed significantly. Some mortgage costs can increase at closing, but others cannot. You have an escrow account. If you do, make sure you understand how it works. If you have questions, talk to your lender as soon as possible before closing day. If something looks different from what you expected, ask why. And for help understanding how to read the closing disclosure and what to look for, use the Consumer Financial Protection Bureau's online closing disclosure form. This is an interactive tool that will provide you with helpful tips and definitions. And by the way, they also offer a loan estimate interactive tool. So you can look both up the closing disclosure and the loan estimate to get some useful tips on what to look for and what each section means. And here's some actions you should take to prepare for closing. Ask the people who are representing you for details about the meeting. Where do you need to be, when, who will be present, how will the process work, how much do you need to pay at closing, and how should you pay. In addition to the closing disclosure, you'll get copies of important documents that you'll have to sign before the meeting. So take the time to review them. These documents include the promissory note, the deed, and the deed of trust. The promissory note is a binding commitment to repay the mortgage loan. The deed is a document that transfers ownership of the property to the home buyer. And the deed of trust is an agreement between the borrower and the lender to give the property to a neutral third party who will serve as a trustee until the borrower pays off the debt in full. It also pledges the property as security for the loan and gives the lender the right to take the property by foreclosure if the borrower fails to repay the mortgage according to terms. If you have questions about these documents or need clarifications, have concerns, then you may want address them before the meeting. There are things you need to do before the meeting. Make sure you have that homeowner insurance in place on the day you close. Shop around, compare costs, coverages. Maybe if you have car insurance, contact your insurance company, see if you can bundle. You might be able to get a better rate. Decide how you want to hold title on the home. Title describes a person's ownership and usage rights to a piece of property. So for example, sole ownership means you have an undivided interest in the property. You are the only owner and responsible for any obligations. Joint tenancy means 2 or more persons share equal ownership of a property and are all equally responsible for any obligations. Now, title vesting also affects your legal rights or to sell or refinance your home and what happens to the property after you die. So you will need to choose the one that best fits your needs and situation. If you're unsure, which is the best one for you, then you may want to consult a lawyer. Then schedule a final walkthrough of the home. Make sure the seller's completely vacated the property. The seller has agreed to make repairs. Make sure the work is finished. Check that everything's supposed to be where it's supposed to be. For example, if they said the refrigerator will stay, make sure it's there. You also need to make sure you have the payment ready. Ask what the accepted form of payment is and arrange it so that you have it ready to bring with your closing. And if you plan to pay via wire transfer, be sure to put the order 24 to 72 hours before you need it. Now, closing happens when all the following happens. Buyer signs the loan documents, deposits the money required, and if the home is financed, signs the mortgage note. Company disperses the money, and the title company disperses the money and records the deed that transfers the property into the buyer's name and the deed of trust. All the documents are recorded, payments are received, and then close of escrow happens when both the buyer and the seller have fulfilled their responsibilities. And when escrow is closed, you get the keys to your home. Now, before your closing meeting, you'll get a list of what you must bring, which usually includes a cashier's check or proof of wire transfer for the exact amount you pay at close. It's also a good idea to bring a checkbook just in case there are last-minute changes. The picture ID, proof of homeowner insurance, the closing disclosure. Your lender might also request other documents, for example, a gift letter if a relative is gifting you money for the down payment. On closing date, take the time to again read all the documents, compare the closing disclosure to final documents. If there are things you don't understand, something doesn't look right or different, don't feel like you should know the answer. Even if you asked the question before, ask again and get clarifications. Get the payment details, including when they're due and when they're considered late. To whom must you send the monthly mortgage payment? They will go to the mortgage servicer, which may not be the lender. If your home is in an HOA, where should you send your HOA due payments? Do you have an escrow account? An escrow account is where a portion of the total amount, total monthly payment that you make to the lender is deposited to cover property taxes and homeowner insurance costs. So let's review an example. This homeowner's monthly principal and interest payment is $1,200. This is their mortgage payment, the amount that goes towards paying back the loan. The yearly property taxes are estimated to be $3,000, yearly homeowner insurance $1,200. So the lender divides those by 12 and does the calculation, which shows that the home buyer must pay $250 a month towards property taxes and $100 a month towards homeowner insurance. In addition, the home is in a homeowner association. The monthly dues are $250. So that means the homeowner must pay a total $1,800 a month to cover all these costs, $1,550 for the PITI payment, plus $250 for the HOA due. And the PITI payment is the housing payment. When the homeowner makes their monthly payment, they'll pay the $250 HOA dues directly to the homeowner association and the $1,550 housing payment amount to the loan servicer. When the loan servicers receive that $1,550, $1,200 will go towards paying the mortgage, and the remainder, or $350, is saved into an escrow account. Every month, this account grows, and then when the taxes and insurance are due, then the servicer withdraws the funds and uses them to pay the bills on behalf of the homeowner. Now, because the cost of property taxes and insurance adjust and typically go up, even though the principal and interest portion of the payment remain the same, provided, of course, you have a fixed interest rate loan, if you have an escrow account, the monthly payment you make to the lender could vary and may increase over time, and usually does. Here are some steps to take after closing day. Put all your closing documents together and in a safe place, including the closing disclosure, the promissory note, the deed of trust, and the deed. Change your address at your postal service and on your driver's license, bank, credit card, cell phone, medical, auto insurance. Change the locks to make sure you are the only one who has the keys to your home and can control who else might get a key. In addition to the previous owners, real estate agents, contractors, and who knows who else may have keys to your home. So you want to make sure you do that. And ensure that you have service for utilities like electricity, water, gas, trash collection, all set up when you move in. As soon as you get the keys, take immediate steps to help you prepare for the financial and personal responsibilities. Take the time to update your budget adjust your expenses as much as needed to make sure you can cover all the homeownership related costs and still be able to continue adding to savings every month and end the month budget positive. Make sure to include in your budget plan an amount that you add to savings account that's earmarked for home repairs and maintenance. Get used to this new budget for a few months before making major unplanned or non-essential purchases like taking out a new loan, doing home repairs, renovations, buying furniture you don't immediately need. Plan how you will pay and handle the payments. Know when they're due, when they're considered late, where to send them. Set up auto payments to make sure that you don't pay late. If you don't have an escrow account, then you need to plan for your property taxes and homeowner insurance payments. Figure out the annual cost, divide them by 12, and start adding that monthly amount total to savings so that you have the total you need when they're due. Always open and read letters from your lender and your servicer. There may be important changes you need to be aware of. For example, you might get a change of servicer notice. If you're not aware of this and continue sending your payments to the old servicer, then they might get lost in the transfer, and the new servicer might not credit your payments to your account. Check into possible tax benefits, the amount you pay each year for interest and property taxes or deductible items. Now, deductions homeowners can take are capped, so you would need to talk with a tax accountant to see if it makes financial sense for you, but this is a benefit that may be available to you. Now, foreclosure happens when a lender seizes and sells the property because the homeowner has not been making the required mortgage payments. So keep in mind that even if you make your mortgage payments, but you don't keep up with your HOA payments, homeowner insurance, property tax payments, you might face added costs and eventually foreclosure. Make sure you'll always respond to notices from your lender, and if you're having problems keeping up with your payments or think you may fall behind, act immediately. Reach out for help. Contact a HUD-approved housing counseling agency. Their housing counselors can help you learn your options as you work to keep your home. And contact your lender right away and let them know you're having financial difficulties. This will allow the lender time to work with you to create a plan. Take the time to review your homeowner insurance, understand how it works, what it covers, create a list of emergency and non-emergency numbers. If your home is in an HOA, review the bylaws and establish a record keeping system for your important files and house documents, especially all those, deed of trust, all those important documents. You also might want to consider putting them in a fireproof safety box or in a safety box at the bank or at the attorney's office. And of course, meet your neighbors. Once you own a home, it's important that you maintain it in good condition to preserve your investments. So review warranties, know what they cover, when they expire. Homes require internal and external maintenance, so create a seasonal maintenance schedule. Want to replace filters, clean gutters, replace batteries. If you keep up with small maintenance items, it'll help you avoid expensive repairs later. Even if you keep up with maintaining your home, emergency repairs will happen. So it's important that you add an amount to savings every month to cover those emergency expenses as well. So, that you start setting aside money for that. Locate circuit breakers and shut off valves for water, gas, and electricity so you can act quickly in case of an emergency, for example, a plumbing emergency. And check smoke alarms and carbon monoxide detectors to make sure they work. All right, let's review some home buying tips. Make sure you're ready for homeownership. Ask yourself, is this the right time to buy based on personal and financial goals? Are you ready for the responsibilities, financial and in terms of maintenance and upkeep? Are your finances in order? Do you have enough in savings to cover the high upfront costs? Make a list of home features and decide which are wants, needs, and deal breakers. When you're ready to apply for a home, shop around, talk to more than one lender, and compare loan offers. Remember to include contingencies in the purchase contract to protect you from losing the deposit. Hire a professional home inspector. before the closing meeting. Take the time to read all the documents and compare the closing disclosure to the final loan estimate. And if there are things you don't understand, something doesn't look right, ask for clarification. Never be embarrassed to ask questions. And consider taking an 8-hour HUD-approved first-time homebuyer class early. It covers the home buying process, lender expectations, and prepares you for homeownership. Taking it early on in the process ensures you approach home shopping as an informed and empowered consumer. And if you would like help with learning what you can do to reach your ownership goal, consider reaching out to a HUD-certified housing counselor that can provide step-by-step guidance. Again, our counselors are HUD certified, our organizations is HUD approved. You can also look for HUD approved housing counseling agencies on the HUD.gov website. And I'm looking at the time, so instead of a knowledge check, I think maybe we can do Q&A. I just want to show you, you're going to get a link to our workshop evaluation. This is an anonymous form. You just follow the link and fill it out and submit it. If you could take the time to fill it out, we greatly appreciate it. We really do welcome the feedback, and it helps us to always improve our current presentations, learn about new presentations we should be offering. So your feedback is really, really helpful and important. And I also want to quickly talk about our Financial Education Center. This is available to you for free, 24 hours a day, 7 days a week. It also covers buying a home. It has different playlists listed here. Within each one of those playlists, there are a series of short 3 to 10 minute lessons that are interactive. They've got real case scenarios, calculators, videos. They really have a wealth of information. It's available to you completely for free. So please take advantage of this. I think Nevin, you have the link to the, apologies, I should have created the link and put it in the chat. Nevin.
Alessandra, thank you for the presentation. What I'm going to do is I'm going to send an email to attendees after this program, including this presentation slides, evaluation form, and financial center information, so they can have it in one place. Would it work for you?
That would work great. Thank you so much. I appreciate it. Yeah. And this is our contact information. So if you want to work with one of our HUD certified counselors, there's 3 of us. I'm Alessandra, so that's my contact information, but you can work with any of us. And you would reach out, and then we would do like a quick intake call, just to kind of review what your goals are, explain what we could do. And then at that point, if you want to schedule your first appointment, then we go from there. And our counseling is completely free again. We only charge one small fee to cover the cost of pulling the credit report if you want credit counseling.
Thank you, Alexandra. That was a great presentation. You covered all that information. And thank you for joining us all. I think we can stay 5 more minutes. If you have any questions, please type them in Q&A or chat. So Alessandra will try to answer them. Okay, one question in chat, Alessandra,
Okay.
can you explain points on a mortgage and any pros and cons?
Yeah, so points. Points are basically origination fees. So these are fees that the lender will charge you for process, making the loan, doing all the paperwork for doing the loan. Each point is so you can't have more than 3 points, and they can be a combination of origination charges, costs, and also prepaid interest. So for example, some home buyers want to lower their interest rate, so then their regular monthly payments lower, and so they prepay some interest, whether that's you know, that's something you should do. That's a very personal kind of consideration. It depends, you know, do you have enough liquid cash to afford this upfront payment, on top of the down payment and the closing costs? And so that's a very personal decision. But that's those are points. So there can be both prepaid interest and they can be also, but typically there's always origination charges points that you're charged.
Thank you. Any other question? Again, I am going to email you all after this program. And thank you for joining us this afternoon. And thank you, Alessandra, for the great presentation.
Thank you, Nevin.
So yes.
And thank you everybody for joining.
Have a nice rest of your day and hope to see you in another webinar.
Yeah, everybody have a great day.
Bye.
Bye-bye. Bye.